Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for the next, gosh, we might push 30 minutes today. We have three things that we want to look at. We have the S&P 500 index, which we've done another bearish trade, and that's in a very interesting area. So the last couple of days have the SPX has gone nowhere, but has gone everywhere, I guess. I think that's another way to say it's been very volatile and trying to establish where it wants to go to next. The marketplace, in my mind, wants to find a reason to have an up week. We haven't had a solid up week in any of the indexes as of late. We're rallying into the Fed meeting, which is a good thing, but the Fed will come out at 2 o'clock today and they'll start their conference calls, and everybody will be weighing on, will be highly examining every word that comes out of Jay Powell's mouth, the chair Fed. And so it's hard to say, but I think it's a good sign that the market is rallying into this meeting. The VIX has came off, and the butterfly that we put on Monday, you may have adjusted on Tuesday. Now, if you go back and review the show and you listen carefully to my trade, I kind of mentioned that I don't know if I would want to adjust that butterfly. And I did screw up in the meeting on Monday, and I do apologize for that, in that I was 1 day off on my expiration and then I had to adjust it. But what was very interesting is that that day really didn't affect the cost of the butterfly. So by making that mistake, we actually learned something. But it really came down to the volatility skew. There's more volatility in the Wednesday date than there was in the Thursday date. And that's mainly because the market is anticipating on the option contracts, not in the VIX, not in anything else, but in the actual expirations of the S&P 500 index, because the market is anticipating more volatility because of the news on Wednesday. And it's a very short-term expiration after the Fed announcement, after Jay Powell gets on camera and starts talking at the end of the day today. Okay. So let's look at that trade. Let's go back and take a peek at it. We do see the VIX down today already, and that's because we're having a decent, strong move in the marketplace. So let's pull up the S&P 500 index, and here's our butterfly that we did. It was an open wing butterfly, and I double checked the expiration to make sure that it is the 19th. And I forgot to wear my green on Monday, and that's also another mistake that I made. So happy St. Pat's Day to everybody. We're going to send this to the ticket. Let's run back to the trading profile. And so right now in the SPX, we're going to look at a FedEx trade today too. But right now in the SPX, we're up $31 or 0.5%. So a solid move to the upside, a solid rally. The March 19th expiration is today. These option contracts expire at the end of the day today. Our first option in our open wing butterfly is the 56.45. And we paid $2.80 for, well, I think we said either $2, I should have looked at it, $2.80 or $2.85. I'll go $2.80. I'll say the $2.80, give us the benefit of the nickel, just to make math fairly simple here. All right. So right now we can close this out and we'll say 340. That's looking like a decent thing. So 60 cents could make 60 cents on the trade. You can take the risk of the announcement after the announcement. So let's look at the vol on this put option, which is very high. Now realize that volatilities will, the math kind of breaks down a little bit on the day of. But this is exactly what I'm talking about, in that the implied volatility for this expiration is 40%. If you just look at the VIX, which is the 30-day vol over here, that's at 20%. So because of that volatility, this trade is doing okay because we're outside of the wings. Now, if we get in the wings, if we go down from this range and we head towards the 56.25, we want implied volatility to come off. And after the known event or after the conference call gets going, I mean, anything can happen. Anything, Chairman Powell is very good at picking his words gently, if you will. But anything can happen in that conference call, and any perceived statements or outlook could obviously affect where the market's going to go to next. So with that said, 56.45. Do you want to take the risk? Here's the question: do you want to take the risk of the positive move and the drop in implied volatility, or do you want to keep this trade on? And if it drifts south, which you could have got out on the way up today, by the way, when it hit 56.25, it wouldn't. You probably were up maybe $1.25 on the trade. Wondering if anybody did that, if anybody was watching it. I did mention that I didn't put this trade on in my own account, but I did watch it. I looked at it on Tuesday because there was a potential roll if you wanted to do it, and in that position to stay bullish, flip the script and to get bullish on the trade as opposed to letting it ride and hope that it lands somewhere in this range. Obviously, if it goes below 56.10, we're still profitable, and that is shown in the what if calculator. And I'll zoom in a little bit on this. Okay, so here's where the market is at. Here's the home run. If it goes all the way down below 56.10, we can still be profitable down on this end. Now remember, we didn't pay $340 for it. We paid $280 for it. So the fact that we're talking about this as if we only trade during Options Guy TV, if that is the only time that you're putting the trade on and putting it off, you have a decision to make today. Do you want to close it right now, or do you want to take the risk of the meeting? And I guess the way that I would approach this is, if I had more than one on, if I had three on, maybe I would close two and let one ride. That would be an ideal scenario, because then you have a decent profit in two of them. But if I just have one on, I'm probably just going to take the trade off right now. I'm profitable on it. There's going to be a lot of risk that's going to happen over the next couple of hours. The market wants to get bullish. It is my feeling in the marketplace. There, anything can happen, but I just kind of feel like the market's looking for a reason to have an up week for the first time out of the last, I think, 4 weeks in a row that we haven't had since we've had a decent week in the general marketplace. All right, so that's it. If there's anybody out there that may have traded it, oh, I see a comment now. Close. All right, Jay says close. Yeah, did you close it, Jay? Or did you? Because obviously the market's up 38 points. So you take 38 away from this. Let's call it 40 points, right? Then you're looking at 56.15. So you're right in this range. So the market would have came through this strike, which you still had pretty decent volatility, but it still should have been trading for more than it is right now. So very, very possibly somebody might have closed it when it hit 56.25 today. And that's what I was asking. Okay, so let's look at the next trade that's in the what if calculator. The AMD, not short call vertical. We got to flip this around. So let's send this to the what if calculator. We got bullish, strongly bullish in AMD going out to the 17th of April. And that trade is okay right now. AMD. but not much has happened. We're up $1 on the day looking at, but to me, this is fairly important, okay? Because if you look at the chart, there's a big reason why we did this trade. So this one is the buy, this one is the sell. April 17th, and stock's at 105. So we haven't gone much on this trade. We're actually down a smidge. I think we put it on for 7. All right, Jay. So interesting, Jay. Jay, go ahead and throw that comment up. So Jay has not closed it, and you're exactly at that precipice, right? You could have closed it this morning if you were watching it when it hit that short strike. But if you do ride through the conference call today, implied volatility should come off. So you have a good chance, the maximum that the trade is not a good chance, but I know I shouldn't have used that terminology, but you have, if the market does go down, you're having from this point on, there's going to be a large rate of time decay in the SPX options, and some of the volatility should come off because of the known event happening. So if you get the market in the right direction, you might be rewarded handsomely today because you just, you want it to land as close to that short strike as possible. So it's a coin toss. It's literally a coin toss right now. Do you take the small gain or do you take the risk if you got a one lot in? All right. So let us know on Friday. Come back, Jay, and let us know what you ended up doing. Okay. So here's the AMD trade. So this goes all the way back, and I'm going to pull up the chart on AMD, and I'm going to go back 15, I think it was 1,300 days I wanted to do. And just to highlight the strong area of support at the 93 level. And so we did break out from that. So we bounced off of that area. And now if I zoom in here, so this is the reason why, the main reason why I wanted to get into the trade was that move right there. And I have established a higher high, a decent bounce off of this level, back up above the 20-day moving average and looking to go towards the 50-day. Now, I don't mind where this is at. I don't mind what has happened in the charts. We didn't break down. The support held, and I just like where the trade is at. We got a lot of time in that trade, so we'll continue to look at it. But I think it was important to just highlight the fact that we did hit that support, and we did bounce off of that support. So far, so good on AMD. And then lastly, FedEx. So FedEx is announcing earnings, and I just like the valuation in the stock, the fact that it's a $247 stock. They announce earnings after the close tomorrow on the 20th. So you have the same situation that I've talked about before, where I like butterflies. You have a fairly expensive stock. You have pumped up implied volatility because of a known event. And so we're going to look to do a butterfly in the SPX. This will be another earnings trade around it. What did I just say? In FedEx, FDX. And we're going to use the very short-term expiration. Right now, the market is here. Implied volatility, wow, vol is way up on that. That's crazy. 142. And you go out 9 days, it drops down to 74, and the historical is 45. That's crazy volatility for FedEx, but they have been in the news a lot. Both FedEx and UPS have been struggling, and the last couple of earnings, they have not done very well. So we're going to do a trade that is going to lean bearish. It's going to be a skip strike butterfly. And once again, to me, this is an alternative to doing a short call spread around earnings. So you're going to sell a spread to pay for a butterfly. I've said this many times before, but I always feel a need to explain it again here on Options Guide TV, in case there's any new listeners that are coming to the show. You need to sell I guess this is right at a 1 standard deviation. That's 18 delta, we'll call it. So 18% chance based off of this implied volatility that the underlying stock would reach that price. And then on top of it, let's put in the most at the money, 46.50. So the expected move is the price of the long straddle. So here we're looking at a 22-point move, strong move, yeah, but implied volatility is kind of showing that. So if I grab my handy dandy calculator here, we go 22 divided by 246.77. I'm looking at a 9% move in the underlying. And if you go 247 plus 22, 269. So 270 is about where the expected move is at. In other words, the marketplace is saying that if the news is perceived as positive, a possible move in the underlying is 22 points. That's the long straddle. It's the over under. It's the line in the sand. If you think it's going to move more than what the marketplace is implying via the expected move, then you buy the straddle. If you think it's going to move less, then you sell the straddle. Just like, to me, placing a bet on a sporting event where you bet on the total score and you bet either it's going to go over or you bet either it's going to go under. So that would be a very speculative trade, obviously, around an earnings event in FedEx. So that's where the expected move comes in. So we want to be outside of that range because that's where our risk is at. Our risk is going to kick in if it goes more than expected. But if it lands right in the middle, it's a butterfly. Once again, just like what we have on today. So in this instance, 18% chance of it reaching this number. The expected move is right down around here. Right now, the marketplace is saying there's a 22% chance of it landing about where the expected move is, right in this range. And then also remember that it's no regard to direction, right? We're not saying that the market's going to go up because the expected move is this. The expected move is expected move. If the earnings event happens, this is what the marketplace is implying. There's a potential move that could happen in the underlying stock based off of just buying and selling, by how much somebody's willing to pay for this call and for this put. All right. So here we go. Let's look at the 272. Yeah, we can get this done for a decent price. We're going to go right to this number. I don't like to use the half point strikes in the show, but we're going to do that. There's no real rhyme or reason. Just a little hard to explain. 272.50. Sell 2 of these. Get rid of this. Make sure I got the right expiration. Been on a roll with that. Okay, March 21st expiration, 2 days away. 272.50. We're going to buy that one. We're going to go up 5 points. And we're going to sell this one twice. And then we're going to skip the 82.50 and we're going to go up 10 points to here. We're going to buy this one. All right, so we got this done for a midpoint net credit of 20 cents to the account. Hoping that the underlying market goes down or stays flat after earnings. You're going to have a $500 margin requirement on this trade. So your risk is from the skipped strike in the butterfly from 82.50 to 82.57. If we just sold that spread, and I'm just looking at the bid and ask, you would pull in 40 cents, right? From 80 cents. Actually, it's about 30 cents. So it's kind of crazy that this is 20 cents. So if we sold this for 80 and bought this, yeah, it's 30 cents. So the butterfly is only trading for 10 cents at this point in time. So if you sold the short call spread, that's what you would get. We're going to get 20 cents in this scenario. We're going to have a $500 margin requirement. And if it lands between 270, 250 and 280, we'll give it, a little bit. If it ends up landing in this range, we could put it on for a 20-cent net credit and take it off. The maximum it could trade for would be $5. So let's send it to the what if calculator. And this will be our paper trade. 1 day, very quick. What's 20 divided by 100? 0.04 or a 4% return in 1 day. If the market stays flat, if it kind of drifts higher, if it goes south, we can make 20 cents on we can make $20 on our $500 requirement. All right. So this is the profit and loss graph. As of right now, market is here. If it spiked up today and moved that 20 plus points to the upside, here's where the profit and loss would be at. But what's going to happen, right, is they're going to announce earnings. Implied volatility is going to go down. 99% of the time it goes down. And time decay is going to happen. And this green line is going to drift, and we're going to end up here. So if we do land between here and here, there's potential to make $5. So very high probability of success. Your biggest risk is that it gaps open, and it makes that gap opening of double the expected move. That is your biggest risk on this trade. And the market opens all the way up here. Now, kind of curious, we're at 20 cents. This is going to be the official paper trade. And I sent that one to the what if calculator. Let's move this a little bit. Any other questions and comments, please put them in. But I'm just going to adjust this, and then we're going to call this a day. The one that I wanted to sell to start with, but we got a 20% chance of getting there based off of delta, is buy this one, sell that one, skip this, and buy that. That's uglier, actually. 14%. Did I do that right? 5 points and then 10 points. Yeah, I don't like that one as much. So we're going to stay where we're at. Like if this would have been a 30-cent net credit, I might have thought about it. But right now, I think the market's still moving. Screen's there. All right, things are moving. So yeah, 14 cents is where it's at. I don't like that. I would want to get at least 30 cents if I moved it down that low, get another dime. That's going to be it, I think, for today. If you have questions or comments, Jay, thank you for letting us know what's going on, see where we end up at after the close today. Hopefully the markets don't take a turn. Highly anticipated that the Fed's going to do nothing. The next meeting out, there's a 25% chance based off of the futures that they may cut, based off of the CME Fed Watch tool, that they may cut at the next meeting, but very low probability, like less than 1% chance that they may cut today or increase, honestly, because that actually is in the conversation too. So with all that said, thank you for stopping in. My name is Brian Overby. Follow us inside the Tradier Hub, hub.tradier.com, to get access to all the great content and all the great speakers that Tradier hosts inside their hub. And then also you can follow me on X. My handle is @BrianOverby. We stream the show live via my X and via TradiersX.com handles. And we'll see you this Friday, see how the FedEx trade plays out. And then also look at what happened with our butterfly in the SPX. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.